Kate, do you have a speaker for me?
Yeah, we do. We've got Nick Battista from TastyTrade here.
Okay, Nick, can you hear me?
Hey, good morning or good afternoon, John.
How are you?
You got to love
What time? How did you know the Fed was going to raise interest rates for the first time in 5 years during your presentation?
It's about time they did. I mean, they've been telegraphing this for a while, and I mean, just looking at the market, yeah, we're getting a little bit of weakness here into the news of it, but it seems pretty muted.
All right, you go ahead and get your PowerPoint up, and
Sure.
I'll read your introduction. As a crucial member of the exceptional customer support team at TastyTrade, Nick Battista has the answers to any questions you may have about the TastyTrade trading approach. He also co-hosts Option Trading Concepts Live, where he is joined by Mike Butler and Katie McGarrigle to tackle your YouTube chat questions in real time. He has starred in various series about managing a trading portfolio, including Market Mindset and Trade Managers. Prior to joining TastyTrade, Nick was an outsourcing liaison and portfolio manager for the Bureaus, Inc., where he held responsibility for business operations related to the productivity, performance, and cost analysis for outsourcing firms and legal firms in the debt collection industry. Nick learned the ropes of options trading from his dad, Tony Battista. I thought I recognized that name. On where do I start? Bat versus bat, has been trading ever since. So you have until 5 minutes before the hour, and I will mute myself and be listening to your presentation.
Awesome. Thank you, John. I appreciate the intro there. That's a great intro. And welcome everybody to this presentation. Glad to have you guys here. We're going to be talking a little bit about a covered call replacement strategy that you can use in your portfolio, whether you want to size down on positions or get a little bit of added leverage to a position other than just buying the stock and selling the calls of capital intensive position. So we're going to be talking about ways that you can kind of get that same directional exposure, but for a lot cheaper of a price, especially on entry. So we're going to be talking about diagonal spreads. We'll be talking about the entry and the trade management. Getting into the presentation here, just to give you a little bit more about me, I do a couple different shows on the TastyTrade network. So if you want to tune in, you can check those out. We broadcast an 8-hour stream live every single day from 7 Central to 3 p.m. The entire market day. There's a plethora of different shows, from research content to beginner stuff to trade ideas and trade management, current events. You even have ramblings from Tom on whatever's happening in the news and whatnot. So a little bit of everything, but mostly trade related. My segments are Option Trading Concepts Live. I do that every day at 11 a.m. Central. We broadcast on TastyTrade as well as on our YouTube chat. So we have our YouTube channel. It's just a TastyTrade YouTube. If you go there to YouTube, type in TastyTrade, you'll come to our channel. We take questions throughout the show. So if you have questions on trade ideas or how to manage a position or concept ideas, really whatever you're looking for, we bring those questions on live on the show, and nothing's off limits. We talk about everything there. So we welcome that if you're interested in joining us there. I also have a couple different shows that are more focused on what's happening during the week. So I've got This Week in Stocks and the Earnings Explorer. These are short little bits that I do focused on trade ideas and just kind of what's happening in the market. A look back at some of the top performers and some of the least performing stocks of the week as well during those segments on Fridays. And then I also do a segment called Johnny Trades, which is focused more towards the beginner option trader or somebody that's trading in a capital limited account. I try to find trade ideas and pitch those to Tom and Tony during our live show at 9:30 Central on TastyTrade on Wednesday mornings. I take those trades using about $500 to $700 in buying power to try and find trade ideas that somebody that's new or that has a smaller sized account can execute in their own accounts to get them started with trade ideas there. And that's on weekly as well. So you can catch me every day at 11 a.m. Central and on Wednesdays at 9:30 Central Time on TastyTrade. So to get into the presentation here, so what with stock positions, you're purely directional, right? So on a day-to-day basis, the market is largely random, and the specific stocks movement is largely random. I mean, we've seen it over the last couple of weeks of big up days, big down days. Net, we've kind of stayed in this tight range for quite some time. A lot of that movement is very random and hard to predict on a very short term time frame. Longer term, you can always project that things typically go up and to the right. That's not always the case, but for the most part, that's how it's mostly been. But on day to day, it's kind of a tough call to say whether a stock will be up or down. With stock positions, a lot of stocks aren't paying dividends anymore. They've cut dividends. A lot of the big name tech stocks use that money to invest in other businesses. It's very hard to buy a stock and expect to have some sort of income via dividends at this point in the market, because a lot of these stocks are growth oriented. There's not a lot that you can do with those stock positions. The value of stocks, right, is all intrinsic value. There's no real extrinsic value that you're getting from a stock other than the perceived potential dividend that you get in the future or the perceived growth of the stock. Those are things that aren't totally quantifiable for an extrinsic value. It's more of a assumption or a directional bias in that stock. With stock positions, it's costly to hedge them, right? So especially if you've got under 100 shares, it's really hard to hedge 20 or 30 shares of Amazon, because you can't sell a covered call if you're buying puts on those. Those puts are very expensive relative to the delta exposure that you have. If you only have 10 or 20 shares, what delta put do you buy? Do you buy a 40 delta or a 30 delta? Those are very expensive options. So one of the biggest downsides is to just having stock is that you can really only hedge it without using any more capital with calls if you have 100 shares of stock. And so what this strategy will kind of help you do is get that same sort of cover call type position while using significantly less cash than you would by just buying the stock and selling the calls outright. So for cover calls, obviously this is a staple of long-term investors. Is probably the most common strategy used by most traders, and especially the less educated in options. This is a quick and easy way to get some options exposure and get some extrinsic value on your positions. Basically, you're selling one out of the money call for each 100 shares of stock that you have. It's the call that you're selling, which is the right. You are selling the right for somebody to call stock away from you at a given price. You have the 100 shares. It covers the one call option. It's easy to understand that you've got that limited upside. You're selling some premium in that call, and that call premium is essentially your paycheck or your interest on the risk of getting called away. That's kind of what some people think of it as. The big thing with cover calls is that you cap your upside in exchange for that premium and that value that will decay over time, and that you could potentially capture if the stock doesn't rise that far or if the stock goes down. It's a riskless position from the perspective of you don't have any risk of losses via that call, but your risk is that you cap your upside, and that's the reason for doing that is because you collect that premium and reduce your downside risk. So with cover calls, we've done numerous different studies. This is one I pulled from our market measures series, which is on at 9 a.m. every single day. We do many different studies on cover calls, strangles, iron condors, diagonal spreads, you name it. So we're all over the place on there, but we basically looked at a portfolio, $1 million portfolio using SPY. This was from 2005 to 2019. So this is pre-pandemic. We get a lot of questions on pandemic has been a little bit of an outlier. This is kind of a crazy market. How do we look at that? So we pulled that data, so about 14, 15 years. We sold the 16 delta call against 100 shares of stock. We did it around 40 to 45 days to expiration, and all these options were held till expiration. And so we compared this, the covered call in SPY versus like just a passively long ETF position, just being long SPY or long one of the Vanguard funds, and kind of checked out the performance there. So as you can see over time, it's up and to the right, and that should be expected, as you know, most of that run was a pretty solid bull market of about 10, 12 years there. So it was significantly to the upside, and you did actually have some outperformance via the covered call, right? So you're collecting premium, you're giving up the potential huge move to the upside for a little bit of potential decay, value decay on the short option. So you did outperform just a buy and hold, which is easy to understand. And you had other benefits like less volatile P&L, because you're selling extrinsic value, which is value that you're capturing. So it's going to reduce your basis and reduce the fluctuations in your P&L. Very easy to understand that when you cap upside, you're going to reduce P&L volatility. You're going to potentially increase returns if you are not moving to a tail type move, to a bigger than expected upside move. It's pretty easy to understand that you'll increase your returns and reduce the standard deviation of returns. Now, the question you might be asking is like, okay, so what's wrong with that? And really, the biggest issue is the capital limitations that everybody has, right? I mean, everybody only has so much money to trade with, and especially when you're dealing with certain account types like IRA accounts or cash accounts, stuff where you don't get any leverage on stock positions, it's really hard to go and buy 100 shares of SPY for 40 grand and sell a call and be fine with $200 or $300 or $400 in premium per month. That it seems like a very small amount to put up that much capital and collect that much extrinsic value, the small amount of extrinsic value. It doesn't seem like it's capital efficient. And if you go and look right now, currently with the SPY, around 435, I did this a little bit earlier this morning, covered call, if you're doing this in a margin account, you use about 21 grand in buying power to put on just one of those positions. So in $1 million account, you could do, if you're going to use all of your capital, you could do up to 50 of these, or half of them would be 25 or 10, something like that. In an IRA or cash account, you're using the full notional value, right? So at 4,300, at $435 a share, 100 shares, it's going to use 43 grand in buying power. So it's a big position to buy 100 shares of SPY and just kind of sit on it. And there's kind of just got to be a better way to get that exposure. And that's what we're going to talk about here via the poor man's covered call strategy. And the reason I use diagonal spread on this presentation is because the name poor man's covered call gives it a bad connotation. It's really just a leveraged way to get that covered call exposure for a much cheaper price. So what is a poor man's covered call? So a poor man's covered call, we're going to go and buy a far in the money call. So that's our synthetic stock position. And then we're going to sell a closer near-term expiration out of the money call, right? So that long call being our stock, the short call that's a little bit shorter duration being our synthetic covered call position, because we're long the stock via that in the money call. That gives us our decay component. So got the long call as the stock, short call as your covered call. And we can use this position to replicate a covered call type risk profile in a shorter duration. So the setup for these trades, and just everybody that's listening, if you'd like a copy of these slides, I'd be happy to send these your way. So don't worry about trying to write everything down, or if I'm going too fast or anything like that, I'll take some questions at the end. But if you'd like these slides, I'd be happy to send these to you. I'll give you my email at the end of this presentation. But Back to the slide. So the setup for this sort of trade, the long option, which is going to be our stock replacement, we want to get that to be as close to a stock position as possible, right? So options are made up of intrinsic and extrinsic value. So intrinsic value, the easiest way to think about that is its actual real value, right? So if an option is $10 in the money, it has $10 of intrinsic value. That is its value right now if we forward to expiration, right? That's how much that option is actually worth in real value. Extrinsic value is the premium of, time, volatility, speculation. That option that's $10 in the money might trade for $15, and that extra $5, that's extrinsic value, and that's what you're going to be trying to buy as little of that in the long option and sell as much of that in the short option as you can to get the best out of this position. So we want to get as close to full intrinsic value on these options, and we can jump over to the platform after this and kind of take a look at some of these, and I've got some images as well. So the higher the delta of these options, the more those options are going to be all intrinsic value, right? So higher delta means it's more close to a stock substitute. So a 70, 80, 90 delta long call option, which is in the money, is going to be mostly intrinsic value, and therefore it's going to act like a stock position, whereas an option that's a 30 delta or 40 delta or 50 delta is going to be all extrinsic value, where it has no real value at expiration given the current price of that underlying. So we want to go deep in the money by somewhere between a 70 and 90 delta. I say 70 because it's a little bit cheaper, but if you really want to get that stock exposure, we're looking for somewhere in that 80 to 90 delta range. And that's really just a combination of high delta exposure, so you're very close to a stock position, as well as little extrinsic value that you're paying when you're buying that option. So we've looked at these long options and just using them as a cover call position and how it changes your probability of success. So when you think back to the first slide, when we were talking about just the day-to-day movement of stocks of being 50-50, you know that if you're selling a call against your stock, you're going to increase your probability of success, right? If stock is 50-50, if you're selling $3 of extrinsic value, you know that you're better than just having the stock alone, right? So there is an inherent higher probability when you're doing something like poor man's cover call. You're going to see a similar type increase in probability for selling that call option. But the thing is that the long option going further out in time, because it's a deep in the money option, it's not going to really change the probability of success, because you're always going to be adding extrinsic value that you're buying in that long option. So there's not a huge trade-off in going from a 60 or 90 day long option to a 300 or 400 day option in terms of probabilities. Now, this is contrary to like what you're looking at in leaps, where the time value that you're buying, the curve of extrinsic value is much flatter as far, as you go further out in time. These are in the money options, so that curve doesn't exist as much as with leap options. So for us, more time always going to be more expensive, but the actual probability of success on these trades doesn't change that that much. So for us, it's really about looking in that 60 to 120 day range, because that's really where the actual probability of success starts to tail off. It's negligible the further you go out with these options. So for our long option, we like to buy that option in somewhere between the 60 and 120 day range. So the setup for the short options, right? So this is a non-scientific chart here, but it's a little bit of it gives you a little bit of an idea of extrinsic value and the curve of decay. So when you sell something and it's out of the money, as time passes, that option decays, right? So with really far out in time options, the decay curve is sort of linear. It goes down X amount of dollars per day, and it's pretty steady. Once you get to around the 50-day mark, around 40 to 60 days, that's when extrinsic value decay actually starts to ramp up, right? So the difference between a decay of an option that's got 50 days to go till expiration and one that is 30 days to go till expiration, it's far from linear when comparing it to a 200 and a 180 days till expiration. Those are basically linear, and you can kind of see this in this chart here of that, very steady sort of decay. And then once you get to the 50-day mark, it starts to get a little bit heavier. So we want to capture this extrinsic value that's decaying, and we want to buy this extrinsic value that's decaying on a much less steep slope than what we're selling in the shorter duration. So when we look at those short options, we want to sell something in this 50-ish days to go till expiration. For the long option, we want to buy something in this range, in the 100 to 150 range for that long option. And that extrinsic value, the short option that we're selling, that's basis reduction for what we're buying in these longer term options. So the setup for these trades with the short option and the days till expiration and the delta. So we've isolated our long option. We want to get that to be an 80 to 90 delta to really mimic a stock movement. With our short option, we look to sell somewhere around the 30 delta short option. Now I put 30 to 50 deltas here because it's really subjective in terms of volatility, how bullish you are on the underlying that you're looking at. Somewhere around that 30 delta is probably a happy median for most people, where you're collecting enough extrinsic value, you're far enough out of the money where you still have some upside potential, and it's a worthwhile call to sell. When you get to that 5 deltas, 10 deltas, it's very hard to justify selling those calls because there just isn't a lot of premium to sell in those options. So around that 30 delta is around that sweet spot, right? Now for your days till expiration, we're always looking in that 30 to 50-ish days till expiration. And the question we get with that is like, why not sell daily? Or if you're doing like SPY, you can sell the dailies or the weekly expirations, something shorter term than a 30-day option. It seems like 30 days is a lot of time to wait. There's always going to be a trade-off between how much extrinsic value there is and how much time is left, right? So when we talk about this curve, yes, it is steeper here, but the extrinsic value is going to be just as low. So extrinsic value is sort of on this same curve as well, where when you get here, yes, your decay is quicker, but the actual amount of money and premium that you're selling is much, much lesser. So that happy median is somewhere around that 30 to 50 days till expiration, which is what we look for the short option here. So we've got our 80 to 90 delta long option, our 20 to 40 short delta option that's in a closer expiration. That short option going to be in a 30 to 50 day expiration. The long option somewhere in a 90 to 120 day expiration. That's our synthetic covered call. So it gives you enough extrinsic value to make it worthwhile. The cost of it is going to be far less than what a covered call would be. And we'll check out some of those examples here as well. So this is one I looked at this morning and got a little bit of a sell-off here into Jerome's taking the stand, I imagine, at this point. So you got E-minis only up 9 at this point. You got Dow in the red, NASDAQ down 88, Russell up only up 20. Interesting market. So I was looking at this morning in SPY. So using our same SPY example, Going out to the 93-day expiration. So this is a monthly expiration out in June. It's got 93 days to go till expiration. Again, there's no, there's not a huge difference between going to this expiration versus, the June quarterlies that are 106 days. You could go to the July 15th, which is 120 days. There's not a huge difference in those options other than the actual raw price that you're paying to buy those options. So I'm looking at the 90-day, pay about $55 for that long option. You can see the SPY is trading at 432 at the time of this screenshot. So you've got about $50 of intrinsic value and the remaining $5 being extrinsic value. So you're essentially paying $5 in premium for a stock position for the next 90 days is what it comes down to. That extrinsic value is kind of your rental cost for this stock position. I'm going out to the 44-day expiration, which is a weekly expiration. The April 29th expiration, it's at the end of April. So I'm going out there for 44 days. I'm selling that 30-ish delta option. It's around the 450 strike. I'm collecting $4.96 for that option. So if you remember back when we were talking about the long option, that long option has about $50 of intrinsic value and $5 of extrinsic value. I'm essentially selling enough extrinsic value to offset what I'm buying in that long option. And that's going to offset the effects of negative decay against you. You've also got a couple rolls that you could build into this position as well, because you have 90 days on the long, 40 days on the short. But net, you're paying around 75% of the width of the strikes here between the strikes. So you've got $65 in total value between the strikes, and there's a little bit more that goes into it. You have more that you can make out of it, or more than that $65, but you're only paying $50 for that position that can potentially go to 65 or more. So your max profit on this, that you're paying 50 or a little bit less than $50 for this position, you can make up to $1,500 on this position if you go fully in the money to the upside. If we go back to 450, 4,500 on the E-minis, it's a potential return on capital of about 30%, right? So this position, it's defined risk. Your risk is equal to whatever you're paying for this spread, which is the $5,000. So you've got defined risk. Your max profit potential, $1,500 divided by what you're paying on this, it gives you about a 30% max profit potential. And in comparison to the risk of the covered call, which is 1-to-1 with the stock, you've got about $300 more in potential risk, which is just the extrinsic value net that you're buying in this position. But there is some things that you have to keep in mind in terms of your risk on these positions, is that with covered calls, it's 1-to-1 to the downside, right? Stock goes down $10, you lose $10 on those shares. You have the call, which helps you a little bit, but you lose 1-to-1. With options, your intrinsic and extrinsic value is dynamic, right? So you can kind of see this orange highlighted. I'm trying to do it with my mouse here. You can see this orange line here. That's your theoretical change in value of this position, right? So this hockey stick is at expiration. This orange line is based on, if it happens now or in the future, how the value of this strategy will change over time. And you can see it's not 1-to-1. With stock, it would look just like this, right? This would be your covered call. Your position would move 1-to-1 just like this hockey stick. With the poor man's covered call, you have a buffer, and that's via the change in value of this long option to the downside. So you actually have a little bit less risk than you do with a standard covered call because of that 1-to-1 movement. And that's because your delta and the extrinsic value is dynamic on these positions. Like I said before, you know that you're going to pay the most extrinsic value for options that are closer to at the money. So if you did get a move to the downside here, this long option would get closer to at the money. So you would have more extrinsic value in this option. Yes, you would lose on the intrinsic value, which is definitely going to give you some losses, but you're going to get a little bit of a buffer or mulligan just via the extrinsic value that gets pumped into this option. At the same time, you lose the extrinsic value that you sold in this option, which is a gain for your position, right? So you sell this, stock goes down, you keep this value, and the extrinsic value of this option gets bigger. It gives you a little bit of a buffer, a little bit more of a buffer relative to that cover call position, which is just 1-to-1 to the downside. So, and that's really just because of the dynamics of your delta and extrinsic value of those options. So synthetically, you're getting the same sort of upside potential as a cover call position, but you've got kind of an embedded stop loss / embedded long put in this position. So when you think about this risk profile, it looks a lot like if you bought stock here, you sold the call and then bought a put, a collar type position. Synthetically, that's what you have here, right? So if the stock were to go, and this would be a catastrophe, I hope this doesn't happen, but if SPY were to go to 350 or 340 or 320, you're capped out at this long option. So you synthetically have a collar type setup via options without having to own the stock. And that's the biggest thing here, is that you're getting a synthetic cover call, a collar type position, and you don't have to actually own the stock to get that exposure. And you're using a lot less capital than it would cost to actually buy the stock. So a couple setup little tips and tricks. We got red on the E-minis now, down to 8 points. So for the setup, we want to, in the short term, the width of the spread equals your max profit. So when we go back to the slides here, oops, getting a little ahead of myself here. When we go back to the slides here, when you think of just a long vertical spread, the max profit is the width of the spread. Now, again, with the dynamics of options, you're going to have changes in extrinsic value. So this long option is always going to have a little bit of extra value, but for all intents and purposes, the width is really your max profit, especially in the short term on these positions. So we don't want to set these up to where we pay more than 70 to 80% of the width of the strikes, right? So in the short term, if you did a poor man's cover call yesterday in BABA or JD, and you get this huge up move, if you paid 90% or 95% of the width of the spread, you probably only made a small amount of money just because that move is just so great in the short term. We want to make sure that if we do get that sort of move, that you have some juice to squeeze from this position. And a way to do that is to make sure that you're not paying more than about 75% of the width of that spread. Again, that extrinsic value, if you think about it from the situation of being long that put worth of extrinsic value, that's essentially your profit over the width of the spread. So when you think about that option, whatever this put, the 385 put is trading for, is what added value you can make on this position past the width of the spread. So the stock, and this is kind of why you see this orange line kind of move up above the max P&L, is because this spread can only be worth 65 bucks. Whatever is left in extrinsic value on this put is what your added upside potential is. So for all intents and purposes, about the width of the spread is your max profit. The higher the delta is on the short option, the more hedge, but the less upside. So this is why we tend to go to somewhere around the 20 or 30 delta for that short option. We want to have enough upside to make it worth our while in terms of the appreciation in the stock or the long option here for our synthetic stock, but we also want to collect a premium that makes it worthwhile to sell that option. So, somewhere around 20 to 30 deltas, that's what we look for. If you want to be more aggressive in terms of, the price not moving up that much, selling a 40 or 50 delta option can get you that might be more in line with your assumption. So for managing these positions, just like a covered call, this is essentially a covered call rental. If you think about it, you're renting it for the amount of days of your long option, but just like a covered call, you can continue to roll those calls forward in time as long as your long option is still open within that duration, right? So in my example, I was using around a 90-day long option, selling around a 40-day short option. You can roll that option week to week or 2 weeks or another month. You've got a couple rolls built into that, that spread, which adds more extrinsic value, adds potential upside and reduces your basis on the position. So for most of these trades, you're likely to have 2, 3, or potentially even 4 rolls within that 90 to 120 or 40-day long option, depending on when you're selling that short option. So if you're selling a 30 delta or a 30-day short option, you're buying a 120-day long option, you've got roughly 3 or 4 rolls built into that position. And when you consider the example that I used here of $5 of premium in that short option, and you think about rolling that, twice in my example, that's $10 total in extrinsic value I'm collecting against a position that's only costing me, 4 or 5 grand. It's almost 20 or 30% of what you're paying in debit for the position. So there's a lot of extrinsic value, a lot of ways to reduce your basis on this position via those rolls. You can roll out in time, again, with all covered calls or poor man's covered calls. You can roll up and out if you're directionally correct. You can roll up and down if you're directionally wrong on the position and get close, get a higher delta option closer to at the money. There's a lot of flexibility that comes with these positions, which, it'll add to your potential upside. It'll add to how much extrinsic value you're collecting, how much basis reduction you're getting. There's a lot of positives to being able to roll those short options further out in time. But I know markets don't go up all the time, right? And we've seen it for the last couple of weeks and months, really, for pretty much all of 2022. We've had a little bit of weakness. So, I had to add in here, and I know a lot of people are don't like to get short delta in any way. Most people are more in the up and to the right camp, but you can use the poor man's covered put, which is essentially the opposite or flip of this poor man's covered call to get a little bit of short delta. And this can be used against existing stock positions. Like maybe you're in a longer term stock position and you don't want to sell the stock for tax reasons or, capital gains, whatever, totally understandable, but you want to take off, maybe you're long 100 shares and you want to take off 50 deltas of exposure, 50 shares of exposure, but you don't want to actually sell out of that stock. Now, one way you can do that is you could buy the puts, but if you're wrong and the stock goes up, you'll lose all that money on the puts, and there's nothing to buffer that value. It's putting up, value that's going to decay against you, and especially in high volatility environments, it could decay against you quickly and be more expensive. So one way to get a little bit of downside protection is via this poor man's covered put. Again, we're buying an 80 or 90 delta option, and then selling somewhere between a 20 and 40 delta option. So again, you'll get the same sort of exposure as you did to the upside with the poor man's covered call, but it's going to be a little bit cheaper of a way to hedge your positions as opposed to just buying the puts. Buying the puts, it's an expensive trade. So it's a cheap way to get a high delta exposure without having to liquidate stock or buy those puts. It's really perfect for, those IRA or cash accounts that are mostly long And the mechanics of the trade and the position are very much the same, but to the downside. And there's a couple added benefits that come into play, specifically into skew and markets that have skew like SPY. So if we looked at one again, I looked at this one this morning at 435 on the SPY or around there. So the poor man's cover put, again, we're looking for that somewhere between 80 and 90 delta for the long option here. It was about a 470 strike, about 90 days out. And then we're going and selling that 20 or 30 delta short option here. I chose the 30 delta. It's around the 410 strike on the downside. So that's 44 days to go till expiration. Again, I'm trying to pay less than 75% of the width of the strikes. Here I'm paying about 60%. It's costing me $3,500 to get this position on, and it'll net have about 50 deltas of exposure. So, you know, from notional exposure in terms of your delta exposure, it's going to be, you know, 50 shares of SPY worth of hedge to the downside. Max profit on this trade is if the stock goes down to 410. Now, remember, this is a synthetic, this is a covered put type position, a covered call, but to the downside. So you do have capped profit potential. You know, it's not the same with the long put where you can make money all the way down to zero, but a more realistic hedge is something like this, where you can get a potential return on capital of 60 or 70% on this sort of trade. Of course, if you're long the stock, you'll feel some pain there, but this is a good way to get a little bit of downside protection, or even play the downside in a shorter duration window, from a 30 to 90 day window here. One of the benefits of the poor man's cover put is that you're playing into skew, and you can kind of see this in the distribution of the stock here. This is just a normal distribution, but you can see the puts, the value tails off a lot lower than where it does on the calls, and that's because SPY has downside put skew. The velocity of risk is perceived to be to the downside. So if you go and buy a put that's $50 out of the money, it's going to be a lot more expensive than a call that's $50 out of the money. And that's skew, and that plays to your benefit here, because you're actually buying extrinsic value on the non-skewed side, and you're selling extrinsic value on the skewed side. So the thing with the poor man's cover put, and with anything that really plays to the downside, is that you have a better bang for your buck on these trades, because of the way the product skews and the way there is skew in SPY. So the same sort of 50 or 60 delta exposure to the downside in SPY is only going to use, you know, half as much capital as getting that same 50 or 60 or 70 delta exposure to the upside in a product like SPY or Qs or IWM or Diamonds or Apple or Microsoft, any of those big name stocks. You'll see downside skew, except if you're looking at Tesla, which usually has upside skew. So a couple takeaways for you on this. And again, if you want these slides, I'll give you my email on the next slide that comes up here. So poor man's cover call and poor man's cover put, they're great alternatives to long or short stock positions at a fraction of the cost. Again, you're using between 20 and 25% of the cost of buying shares in a margin account. For a IRA or a cash account, it's almost 10 to 1, right? So to get 100 shares of stock versus a poor man's cover call, you're going to use, you know, about 10 times as much buying the shares as you would with the poor man's covered call for that similar amount of delta. So it's a very viable strategy for cash accounts, for IRA accounts, for anybody that wants to get leverage exposure. If you're trading with only 10 or 20 or 30 grand and you want to get a long stock position, this is one of the ways that you can get that leverage position. It's going to be super high return on capital versus, you know, how much you're putting up to actually buy this position. So as we've seen, anywhere 30 to 40% potential return on capital on the poor man's covered call. For the poor man's covered put, you can get up to 60 or 70% return on capital. And that's going to be a much higher number than you would see with a covered call type position. And this is even more magnified in a cash or an IRA account, because those accounts, you have to put up the full notional value of the position. So it costs even more than when you're in a margin account. One of the biggest things is that you have less, and it's defined risk in tail events, right? So if you're looking at the market and you say, you know what, I think this interest rate, move, E-minis are up 42 now. If you think this interest rates are going to drag down tech stocks, and there's going to be, geopolitical issues, and, the tail risk is high right now, this is a way to get defined risk, but still keep that same directional exposure if you're doing the poor man's covered call. And conversely, if you think that there is tail risk, the poor man's covered put is a perfect way to get exposure to some downside protection and downside speculation for much cheaper than it would be to short shares of Apple or short shares of SPY, which is a super capital intensive trade. And again, these can be used as directional trades. They can be used as hedges against existing positions. So if you're long shares of Apple and you just want to kind of hedge a little bit on those positions, if you're long 500 shares or 1,000 shares and you want to take off, 20% of that in risk, you can do that via the poor man's covered call without ever liquidating those stocks. So it gives you a little bit of leverage, as well as leverage on the protection side if you are looking to hedge the downside with something like the poor man's covered put. So again, my name is Nick Battista. I am on TastyTrade every day at 11 a.m. Central Time. If you want to shoot me an email, you can shoot me an email to support@tastytrade.com. Just put Nick in the subject or in the body of the email. If you want these slides, I would be happy to send these over to you. Just shoot me an email and I'll send you the PDF. You can have all these with all the links to the studies, and I'd be happy to answer any questions you have there. I don't know how much time we have left on this, John, but I'd be happy to answer questions here, or if you want to shoot me an email, I'd be happy to do that as well.
Yeah, we have about 7 more minutes. Why don't you go ahead and take all the questions you have?
Sure.
And then we'll give away our last prizes of the day.
Awesome. So I see one coming in for, so for a similar strategy for something that's going down would be that poor man's covered put. I imagine that question came in a little bit before I got to those slides. But yeah, you can get that same exposure to the downside via the poor man's covered put that's buying an in-the-money long put that's about a 90 to 120-day expiration, and then selling something on the downside in the 20 to 30 delta range. It gives you that same risk profile, but to the downside. So very similar position there. Jeffrey, come on back and hang out with us. Everything's good in Tasty Land. We're having fun. I mean, this market has been ideal for our trading. You've got tons of changes in volatility. I mean, you've had volatility up 10% on a day and down 7-8%. It's perfect. For directional assumptions, it's been amazing. I mean, if you're selling puts on stocks that were down a couple days ago, you're getting paid in 2 or 3 days. It's been a really fun market to trade in here. So Mary Jane, at inception of the trade, does it matter what the IV of the underlying is? So it's sort of it doesn't have a ton of exposure to implied volatility, because your long option that you're buying is synthetically a stock position. So it's not going to have a ton of volatility exposure on that option. The option that you're selling is going to have, would benefit from volatility being higher. But the trade-off is if volatility is higher, that long option is going to be more expensive. So this sort of trade, it doesn't totally rely on high implied volatility. Like for a covered call, high implied volatility clearly benefits you by, when you sell that call, you're selling it for more premium than it would be if the volatility of that underlying was lower. So with the poor man's covered call or poor man's covered put, volatility has less to do with it. But the expectation of high volatility is that the stock's going to move. So you'd lean towards something that's got a little bit higher volatility. Where's the second part of this? So your short option, the second part of this question, is it necessary for the short option to have higher IV than the long option? So you're always going with the long option, it's going to be synthetic stock. So there's not going to be a ton of IV in the option itself. But anytime you're buying a further out option, you're always going to have more extrinsic value or more volatility in terms of more vega exposure. It's just that vega exposure is a lot less sensitive to short-term volatility, right? So volatility sort of has a curve where it goes up in the short term and then kind of tails off in the back months for most underlyings. There's a pretty decent contango that exists in option pricing. So the raw number that you see in IV is going to be greater for a longer dated option. It's just not going to have that much effect on it in the short term. I got one from Michael as well. And thank you for hanging out with us on TastyTrade since 2016. Good job out of you. That was right around when I started. Appreciate the kind words, guys. And thank you everyone for the good stuff you posted in the chat and for hanging out here. I'll give it back to you, John.
Thanks, Nick. We
Thanks,
appreciate
Nick.
it.
Thank you very much. Outstanding presentation as always. Look forward to having you back in June.